Today is Tuesday, January 27th, 2026, and at 10:35 a.m. ET, BigBear.ai Holdings, Inc. is trading at $5.84, marking an intraday gain of 2.10% on significant volume as the morning session finds its rhythm. While the broader market focuses on the headline growth of AI giants, BigBear is quietly executing a financial transformation that many retail traders are missing entirely. Most investors see a small-cap defense contractor struggling with inconsistent revenue, but the real data point creating tension right now is the massive, nearly total elimination of the company's convertible debt. In the last few weeks, management has successfully converted about $125 million in senior secured notes into equity. This move effectively slashed their interest-bearing obligations from over $140 million down to just $17 million. This isn't just a minor adjustment to the ledger, it is a fundamental reset of the company's risk profile. The common market belief is that BigBear is a speculative play trapped in the shadow of Palantir, relying on lumpy government contracts that make quarterly performance unpredictable. Investors often point to the 20% year-over-year revenue decline in the third quarter of 2025 as evidence of a business model that hasn't yet reached escape velocity. However, the contrarian perspective suggests that the market is lagging behind the company's shift toward recurring software revenue. The recent acquisition of 𝐅𝐈𝐍𝐀𝐍𝐂𝐈𝐿𝐿, which is expected to bring in roughly $25 million in annual recurring revenue, changes the math. Unlike traditional service-based contracts, this provides high-margin, predictable cash flow that the market hasn't fully priced into the current valuation. Recent price action shows a stock that is highly sensitive to institutional positioning and short pressure. Over the last week, we have seen BBAI bounce between $5.60 and $6 with aggressive intraday volatility. Trading volume has remained elevated, often exceeding 80 million shares daily, which suggests that high-frequency traders and institutions are battling over these levels. Institutional ownership currently sits around 33%, a figure that has been creeping up as the balance sheet cleanup reduces the threat of insolvency. We are seeing a divergence where the daily price swings are dictated by retail sentiment, while the floor is being established by institutions who are looking past the current net losses toward a leaner 2026 fiscal year. Broader macroeconomic forces are also playing a heavy hand here. As the federal government looks for efficiencies under new administrative pressures to cut spending, the demand for decision-dominant software that can actually identify waste and optimize logistics is rising. BigBear's recent partnership with the Kraft Group and its acquisition of CargoSeer for AI-powered trade risk management are direct plays into this trend. This isn't just about defense anymore, it's about commercial supply chain resilience. Short-selling awareness is absolutely critical for anyone watching this ticker. As of the most recent exchange data, short interest remains exceptionally high, sitting at approximately 107 million shares, or nearly 25% of the public float. This puts BigBear in a unique category of stocks where a sudden positive catalyst can lead to a violent move upward. The borrow rates have shown intermittent spikes, suggesting that finding shares to short is becoming more expensive for hedge funds. Firms like Cantor Fitzgerald recently moved to a neutral stance, citing competition, but the underlying short interest tells a story of a market that is heavily bet against a turnaround. Retail investors need to interpret this short data with a clear head. While a 25% short float is a classic ingredient for a squeeze, chasing that narrative without looking at the 38 million new shares issued during the debt conversion is a mistake. The dilution is real, and it provides a buffer for shorts to cover if they are patient. Comment how many shares you currently hold, or if you think this short thesis is finally starting to crack under the weight of the improved balance sheet. Institutional buying behavior has been mixed, but the narrowing of the projected 2026 loss per share from 32 cents to 25 cents over the last 2 months indicates that the smart money is starting to model a path to profitability. The company is no longer just a project-driven contractor. It is evolving into a platform-centric AI firm. They specialize in taking massive, unstructured datasets and turning them into actionable intelligence for the Department of Defense and high-stakes commercial sectors. Their business model relies on integrating AI into existing workflows rather than forcing a total rip and replace, which has been their primary advantage in winning government favor. Retail sentiment on forums like Reddit and X remains a vocal but minority influence. There are frequent discussions about the stock's meme potential, given its low market cap and high short interest, but the serious debate centers on whether BigBear can stabilize its core Army program volumes. Retail traders can certainly drive short-term momentum and trigger stop losses for the shorts, but they cannot influence the long-term contract awards that determine the stock's terminal value. The call for transparency in how the Navy's Seaport NXG contract is being distributed among over 1,000 vendors is a recurring theme that highlights the competitive risks retail investors are rightly concerned about. Looking toward the future, there are several scenarios that could play out. The most bullish case involves the 𝐅𝐈𝐍𝐀𝐍𝐂𝐈𝐿𝐿 integration exceeding expectations and driving a 60% climb in the share price as the market re-rates BigBear with a higher software-as-a-service multiple.
The risk, however, is that the recent share dilution from debt conversion creates a permanent ceiling on the price, making it difficult to sustain a breakout above the $7 mark. Upcoming catalysts include the special meeting of stockholders in mid-February and the March earnings report, where management will have to prove that the revenue decline has bottomed out. The gap between investor expectations and the reality of the company's financial health is narrowing. For years, the story was about a debt-laden SPAC merger with high potential but a broken balance sheet. Today, that debt is largely gone, replaced by a more stable but diluted equity structure. The reality is that Big Bear is a much safer company today at $5.84 than it was 6 months ago at $7, yet the market is still treating it with the same level of skepticism. This creates a fascinating setup for the rest of the quarter. To wrap this up, BigBear.ai has successfully navigated a high-wire act of financial restructuring. They have traded dilution for survival and recurring revenue for project-based uncertainty. The market is still trying to decide if this is a picks and shovels play that can compete with the industry leaders or just another small cap that will be consolidated into a larger prime contractor. The balance sheet is clean, the short interest is high, and the technology is proven in the most demanding environments on Earth. Whether that translates into a sustained rally or more range-bound trading will depend entirely on their ability to turn their record cash reserves into tangible growth in the next 2 quarters. Would you like me to analyze the institutional flow for another AI sector peer to see how they compare?